Will NVDA be the first company in the stock market to reach a $10 million market cap? Recently, as you can see here on my screen, the NVIDIA price through the last 6 months has been pretty stagnant, staying around this range of 170 going all the way up to around $200 based on bullishness or bearishness with the AI trade coming up. You can see today it closed at a price of 138, down from about that $200 it got up to from around its earnings, even after they had a blowout earnings, which we're going to show you later. Let's get into what we're going to be talking about during the video today. So the first thing that we're talking about is obviously our NVIDIA, our 2026 projections, the business model, grading this last quarter, and what we see from them. And then we want to touch on two of our other stocks that we've recently been releasing videos about and telling you guys that we think they're great, fundamentally undervalued opportunities in the market right now, Sofi and Zeta, and all the events happening with those stocks. So real quick here, this is NVIDIA's financial results for the fourth quarter 2026. They report their numbers in 2026 for the year 2025. So this year for them is actually going to be their fiscal year of 2027, even though for us it's going to be 2026. So basically their revenue was up 73% from 1 year ago, which for a company like this, how big they are as a market cap is unbelievable for them to be growing at these growth rates still. And you're going to see, we think they have about another year left of huge growth before they start going down, where it's just with the AI super cycle and AMD possibly coming and taking market share. Their data center revenue, so all the GPUs and everything, up 75%. So you're seeing that that's still one of the highest performing aspects of their company. And their full year revenue was up 65% from the last year, which is unbelievable. And we think the P's and everything that they're trading at right now are super, super undervalued to what they really should be. So just that outlook for this next year, their first quarter, they're thinking it's going to be a $78 billion revenue, not including China. So basically, they're probably going to be able to get revenue from China, and that's going to take their revenue up to even newer, huger levels that we don't even see coming right now, because like them, AMD, they're not incorporating this in because they don't want to mislead investors, and they completely blew out the guidance. I think guidance was around a $72 million revenue for this first quarter, so it's huge up, and there's no reason it should be down. Their gap in their gross margins, so gross margins, like we've talked about before, is so you do revenue minus cost of goods sold, and you get your gross profit, and you divide that by your revenue. So basically, after their cost of goods sold, they're keeping 75% of that money, which is off the charts for these companies, and something that we've talked about before, that AMD is going to come and eat into these because they're able to charge so high prices for these chips just because no one else has them, like their B2000 and all these chips, that in the future it's going to be hard for them to keep these margins up. And that's one of the biggest problems with them, is that as soon as other companies come into the marketplace and take this, even if it goes to a $1 trillion market in 2029, it's going to be hard for them to sustain that pricing power. Their operating expenses are expected to be 7.7 to 7.5 billion. So to get all the way down to net income, it goes after you get your gross profit, then you subtract your operating expenses. Then after that, it's just any one-offs, almost something like maybe an interest expense or something there, and a tax rate is all you're going to do off there. So like I said, they had a banger of a quarter, an A+ income statement for this company. And like we always say, you want to see this top line here, revenue, you want to see it getting bigger and bigger, these beats down the line, to show that they're operating efficiently and not overspending. And you can see that their gross margin went up 2 percentage points, which from already a high margin of that, 73%, is huge for this quarter. Their operating expenses were kept super in check, only going up 45%. Even though their operating expenses are way lower, they keep them down, which allows them to expand those gross margins and operating margins to, on the bottom line, increase their net income margins and increase net income more than the top. And that's why you see this operating income is 84%, so it's higher than revenue because they kept their spending and everything in check. And the net income is even better at 94, and then they're even buying back a percentage of their shares on top of it. So their diluted EPS gain is 98%, that's why this is an A+. They didn't mess up anything. Top to the bottom, they're increasing all those values year over year, which is exactly what you need for a company to put confidence in what you should be looking for to making sure, or if there's something wrong, you listen to their conference call, and maybe they're going to talk to you in there why, hey, this was higher, this was lower. Maybe it's something for the future, so you got to kind of understand that. Now, the part that everyone wants, what are our projections for it? Well, we have a PT of $294 as our midpoint in 2026. We get there because we think they're going to grow net income at 77%. Revenue is starting to decelerate like we saw. So we only give them throwing at 55% this year. A net income margin is going up to 62%, and we have them at an EPS for the year of 8.5. Slap on a PE of 32 to 37 we think is fair for what's going to happen after 2027, because when we're kind of doing our PE ratio, we're seeing, hey, what's the share midpoint price we're going to get? Then we divide it out by their EPS to get their forward P, and then we want their forward P to be roughly around net income, because you're going to look at the forward peg, correct? And whenever you do a peg, it's the projected next year forward P divided by the projected EPS increase. So that 24 divided by 24. And generally with companies, 1 is average, under 1 is undervalued, over 1 is overvalued. But there's some sectors that are going to have a higher peg or a lower peg. So for example, a semiconductor, a SaaS company, maybe is going to have a higher peg because there's going to be higher growth than a company like a Home Depot or a Walmart or something that's really inherently not growing as much, and they're kind of not spending too much on capex, and they're just trying to keep the same rates in the future. So you kind of know what they're going to be priced as. Now, those companies right now, we're seeing a Walmart and a Costco trading at super high Ps, higher a 4P, double NVIDIA's, because people are so scared and so hedged about the market that they're going to go into these things called so-called value stocks, which are going to hold up better if there's an economic downturn. So that's what you're kind of seeing in the market. If you see Walmart's trading, hey, way higher than NVIDIA, and people are scared of NVIDIA because of the AI trade unraveling. So with this price target, we have a 57% increase for them to get to this price. We have a pretty conservative P and approach here, only getting them to a 1 peg, because obviously we want to be surprised in the future of what they can do. Recently, I think they're trading between a 0.3 to 0.7 peg, which is ridiculous right now. They're so low for what it should be. That's ridiculous. And the problem with them, though, is more so in the future, once these revenue rates and net income growth start coming down, that PE, like you're going to see, is going to get lower and lower and lower in the future, just due to the fact that people are saying, hey, they're decreasing these growth rates. My money, the growth investors are going to want to go to some other place, and it's hard for the value investors to even get in, because it's like, what are they really going to get down to, these ratios? So you have the AI on top. Maybe it doesn't work out. They do have a crazy part of the market, but just the valuations that you're going to have to put on them and the Ps that they're going to be trading at for that growth they get in the future makes them a hard thing for a longer term investment, where sure, they could do great, but they could be stuck in this range of under 400 for a very long time and be almost a value trap after this year with their numbers they get. And depending on this year, how much are people going to start pricing in the future? And that's why we think AMD is such a better opportunity, because they're going to be growing steady and even better, increasing net income, increasing revenue over the next few years, commanding a much higher P ratio. And they're going to be growing EPS at a higher rate, have a higher EPS like by 20. So you can easily project them a lot more and easier than NVIDIA, where there's a lot more question marks about this, because you see these growth rates just go down so fast during the year. So NVIDIA, obviously right now, absolutely it's a buy. You're going to get a 57-60% CAGR. Even if you look and hold it in 2027, you're almost doubling up your money, over doubling up your money almost, if you get a little bit higher on that pricing wise with this stock. So that's pretty crazy what you're going to see with them. Now let's get into Sofi, a stock that we've talked so much about on this. We have so much confidence in them, what their stock price is at, where they bought them. Then we're going to show you what our projections are, still the same ones that we've had all year. And could they get higher than? Absolutely, with their growth rates. So basically the big thing what happened this week is Anthony Noto bought $1 million worth of shares, because he wasn't able to because of some things with tax, and he didn't want to pay a crazy amount. So on the first day he could buy, he bought. Whenever you see a CEO buying shares, that is so bullish for a company, and that shows so much confidence in them, compared to if they're selling. Sometimes people sell for no other reasons, and sometimes it's really bad. But selling is, you don't know why they're selling. It could be tax reasons, people need money. But with this here, Anthony Noto is so bullish for the stock, and you can kind of see that people are realizing that it's undervalued as a SaaS play. They got all the way down to 17.3, and now they're almost at $20 after today, outpacing the market. The market was red today, and they're still up 3% on the day, which shows that this stock should be getting hit if there's a recession, but they've already went through their correction. They're already down off those highs from 32 all the way to 17. They almost had a 50% correction. They're still down by 35 to 40% in a fundamentally sound business model that has beat the last 2 years in a row with a great CEO who has confidence in their company, a beautiful balance sheet, beautiful income statement. That's exactly what you want to look for in a company. Those are the three biggest things. Fundamentals, being undervalued. You want to look at their balance sheet and income statement. Are they going to be great? And management, are they beating expectations continuously so you can actually project and hitting their numbers? And are they being smart in their offerings, buying back, and their confidence in the company? If you have those three things, that's exactly what you want to be looking for companies in. If you're within your margin of safety saying, hey, I think this is going to go this much here, you can slap on a P, slap on EPS, get your share price. That's exactly what we're trying to teach you here, and that's exactly what we're going to be bringing to you guys tools in the future that we're going to be showing and showcasing in here for you guys to use to help you with all this projection, save your time, and think about the biggest thing you want in life, that dream to have a huge portfolio. If you invest like this and learn from us and use these tools to help you look at so many different companies and find the best opportunities in the market, then you're going to be so successful in investing, and it's going to pay so much off for your life instead of having to just put money in an index fund where you could be returning 25, 35, even over 50% on average a year from your portfolio, where you're confident every single one of those plays because you've done your due diligence, you've done your research, you've done your projections, and allow us to help you and show you what to do with them to make your life better, your families, go on those vacations, retire early, live the life you dreamed of, and invest like people on Wall Street and people in all these other places and have confidence whenever you're doing it. So like we said, you want to run projections. We have Sofi at a PT of 37. They're going to be growing at a 0.68 EPS is what they're going to get to. In the future, they're going to be growing at a 40% net income growth and a 37 midpoint. So if they get to a 37, their forward P is about a 38, which is a peg under 1 for a SaaS company growing at 30 to 40. It's pretty undervalued. So we could see them going higher. We could see them going into the 40s with these P ratios they might put on them after they put up this growth this year, because you always want to be looking towards the future. And they're trading right now, we have them at $19. That is a double up from here and this year. And that's the stocks you want to look, the stocks that have corrected at this time in the market, that if there is a correction or something to go down, obviously everything's going to go down. But if there's only a mild correction that you get, because you never can tell, maybe it's a 5%, which we don't really see anything happening right now, stocks that have already gone hit this hard are actually going to fundamentally go up in it because they've already had their correction. Something like a Sofi, something like a Zeta, and something like all these stocks. So even NVDA that we're trying to show you that are so grossly undervalued. And this is a year where it's going to be a stock pickers year. You can't just go and put your money into some stock and momentum trade it and say, hey, this is going to the moon. No, this year is a lot more risk off than we've seen in the last 3 years. You need to find good plays that are fundamentally undervalued and stay in those, and make sure you have your utmost conviction in the management in that company to execute on your projections. Because if you don't do that, you're going to get caught off guard and killed in this market if we have a huge dump. So another one we love and we've been talking about is Zeta. It got all the way down to a little under $15, and we were saying buy, buy, buy every time. They had their, like I was talking about, you want to see management. Are they beating? They've had 18 straight quarters of beat and raise guidance. So they beat the numbers and raise them. So usually whenever you're projecting, your numbers are actually going to be low, and you're going to have to go into your models and raise it up. And they're not even including their Marigold acquisition too much, and they're sandbagging that. So that's just making their numbers look even better in the years and better in Wall Street's eyes whenever they realize that this is actually happening. They are up off their bottoms even about 20% if you bought last week. And obviously you want to have a long-term view, but it's just times like this whenever stocks get to silly valuations. The IGV was down from almost 119. It was down like 40%, almost 30, 40%, this whole thing. And you can see at the bottom, that's why these stocks are going up, even the market's shaky right now, because they've already had their sell-off. And that's what we're trying to tell you. Fundamentally undervalued positions like Zeta, like Sofi, like NVDA, like AMD, like Celsius, like Oscar. All of these stocks here are undervalued, and they have management that's doing the right things and hitting their projections. These are the exact companies you want to buy and hold for the years. instead of a company that's a momentum trade. Because what happens if you're buying at MU and it's a momentum trade? What happens whenever they don't need memory anymore? I wonder what's going to happen to their PE if their growth rates and those go down in the future and companies don't need them, and companies don't need as much RAM or memory and they oversupply. That's why you want to look for fundamentals like these that you can believe in and check off all your boxes for the company, then have conviction. And if they go down even more, we've been buying Zeta, we've been buying AMD, we've been buying Sofi since a little bit higher because we already thought they were undervalued. That's why you always want to keep cash. And if they keep going down more and more, you keep buying more if your conviction stays the same, if nothing fundamentally changes in the stock, nothing fundamentally changes in the management. That's whenever you buy a stock, you almost want to see it going down because you can get more shares at such a lower price. And imagine you kept buying all the way down to 15 like we did, right? Just look at these numbers we have from $15. Remember this, that it was, even it's still trading at 19. We have a PT of this year of $45, and that only puts them at a forward peg at 0.93 if it hits that. 150% gain this year from these prices, which is unbelievable. If it from these ones here, if it's right now a 200% gain for our midpoint, and at the high end, 50 is over a 200% gain. In a year, it's hard to find stocks. Like I said, you want to find stocks in defeated industries that have great business models, beat numbers, and they finally reached an inflection point with net income. They're finally turning positive this year. You give them an EPS of 1, slap on a P of 40 to 50, and they get a 40 to 50 share price this year with a middle point of 45, all the way from $18, which is still over a double up right now. It's a buy today. It was a buy yesterday. It was a buy a month ago. Even whenever it was in the 20s, it was still a buy. You still should have been DCing in at that point because you're still getting over a double up from that price you bought in at. This stock is great. They're the future. They're not going to be disrupted with SaaS because they use AI. They have all this first-party data. They get 90% of their revenue from customers they've had for more than 1 year, showing that they scale within those companies. And their revenue goes to the moon, and it goes down on the bottom line with net income. And also, it makes down their expenses because they don't have to go in acquisition with another company and take time to integrate within them. These companies here, they're already integrated in them. For example, they're in over half of the Fortune 500 companies, so they just keep building out. So it's relatively cheap for them to keep integrating, and they turn money into profit for them. So that's why we love Zeta, we love Sofi, and just a testament is if they go down more and this bounce is short-lived, you keep buying. If you see a bounce more down, you buy, because if you have that conviction, you want to keep loading up because you're going to be repaid in the future years. Whenever you get these price targets, look at this. We have them going over $100.29. If you buy at $15, that's almost a 7 or 8x whenever you hit this price. SoFi right here, you can buy at under $20. Just go until 2028. That's over a 3x as our base case. And these numbers are probably low because Noto sandbags and Zeta sandbags. So these numbers could even be better and better in the future, as we have to think about and understand with these companies. Is they say one thing right now, but they're only going to get better, and they're only going to get more institutional ownership, and they're only going to go higher as people realize, hey, they might be a disruptor. They got their people. They're growing members. They're getting new clients. So like we said, a lot of information there, just teaching points with investing. Stay tuned for what we're going to be having for you as come soon. And we're going to be showing you guys a whole new type of investing style to your research, make your time easier, and help you achieve those goals. Just think, what do I want in life right now? Am I willing to work for it? And think, what do you have constraints? Maybe it's time. Maybe you don't know where to start. Maybe it's hard to get data. Well, we're going to help you with all that, teach you how to invest, and give you tools to keep your time down, research so many more companies, and understand business models, and allow you to become a better investor, whether you're a beginner, intermediate, or you're an advanced who's been in the market for a long time. So just make sure to like and subscribe, and stay tuned for these huge aspects that we have coming for you guys.